Imagine walking into your local grocery store and finding the aisles completely bare, with the everyday items you rely on simply unavailable. The global network of manufacturing and logistics is undergoing its most significant reorganization in 30 years. For decades, the math for multinational corporations was strictly focused on the bottom line: build factories wherever labor and materials cost the absolute least. As you can see in this map, that relentless pursuit of cheap production pulled hundreds of global trade lines into a single, densely packed manufacturing hub in Asia. By optimizing the entire planet for extreme efficiency, businesses engineered a massive vulnerability. They built a global trade network with one critical point of failure. When geopolitical tensions rose and a pandemic forced sudden lockdowns, those centralized factory gates slammed shut. A localized shutdown on one side of the world instantly created idle container fleets and congested ports globally, freezing international transit. The logistical delays trickled down immediately to the retail level. Scarcer goods drove up prices, accelerating inflation, while simultaneously wiping out corporate profits. Boardrooms across the world learned a harsh lesson in basic economics. The lowest cost of production carries a hidden, devastating risk when deliveries stop entirely. What used to be a reliable engine for profit generation became the most dangerous liability a modern business could carry. To protect their operations, multinational companies are moving billions of dollars in capital to actively de-risk their supply lines. The strategy is called geographic hedging. Watch how the single manufacturing core breaks apart here, pushing new production nodes into emerging markets across India, Vietnam, Mexico, and Eastern Europe. If one of these specific regions goes dark due to a strike or an export ban, the network adapts. The surviving regional factories simply increase their output to absorb the shock. We are already seeing this physical shift on factory floors. Facilities producing garments and consumer electronics are rapidly expanding in places like Vietnam. The exact same expansion is happening in heavier industrial sectors, with complex appliance and component assembly lines scaling up across India. Companies that build this physical redundancy today are positioning themselves to capture market share when the next global disruption paralyzes slower competitors. The second pillar of this strategy brings the product closer to home. Nearshoring moves finished goods across land borders directly to primary markets. By utilizing local rail and trucking networks, companies bypass the physical delays and deep unpredictability of transoceanic container shipping entirely. Behind the scenes, logistics teams are deploying predictive algorithms to monitor global weather patterns, port congestion, and raw material shortages in real time, routing around bottlenecks before they even form. And to guarantee availability, the decades-old just-in-time delivery model is being replaced. Warehouses are now stocking deep reserves of strategic inventory, acting as physical buffers against future shocks. True defense requires physically decentralized factories and the predictive data to manage them effectively. This pivot away from a single manufacturing giant is a multi-trillion-dollar reallocation of global wealth. The nations actively capturing these corporate contracts are experiencing massive economic booms, financing sprawling new port facilities and industrial zones to handle the volume. This influx of capital is elevating local economies far beyond basic goods, funding the construction of highly complex automotive and aerospace assembly lines. The countries that successfully build the infrastructure to support these decentralized corporate networks will dictate the terms of global trade for the next 50 years. For the everyday consumer, this transition sets a completely new baseline. The geographic origin, the availability, and the final price tag of nearly everything you buy is being permanently recalculated. For investors, watching where these multinational corporations lay their new foundations reveals the exact emerging markets positioned for aggressive, long-term expansion. Logistics networks are being intentionally re-engineered into an interwoven web designed to withstand the volatility of the coming century. If you want to understand the macroeconomic forces driving these global shifts, subscribe to the channel. Because the massive movements of wealth that shape our future always begin quietly, long before they ever make the evening news.